5 top financial mistakes to avoid as an entrepreneur. Starting a business is an exciting journey full of possibilities and promise. But being an entrepreneur comes with a lot of challenges, especially when it comes to money management. Financial mistakes that could have been prevented with diligent planning and understanding have caused many promising endeavors to fail. To guarantee that businesses prosper and grow sustainably, we will look at the top 5 financial mistakes entrepreneurs should avoid in this video. Number 1. Neglecting a detailed business plan. One of the foundational pillars of a successful business is a robust and detailed business plan. This document serves as a roadmap, guiding the entrepreneur through each phase of their venture. Despite its importance, many entrepreneurs either forgo a business plan altogether or create one that is too vague to be useful. A comprehensive business plan should include market analysis. Understanding your market is crucial. Who are your competitors? What are the market trends? What is the size of your target audience? Financial projections. Detailed projections for revenue, expenses, and profit margins over at least the first 3 to 5 years. Funding requirements. Clearly define capital needs and how these will be met, whether through loans, investments, or personal funds. Operational plan. An outline of the day-to-day operations, including staffing, product sourcing, and logistics. With a comprehensive business plan, entrepreneurs can avoid becoming lost and ending up making reactive rather than proactive decisions. This may result in misallocation of resources, missed opportunities, and eventually financial instability. Number 2. Underestimating startup cost. Many new entrepreneurs underestimate the cost associated with starting a business. This mistake can be particularly damaging as it often leads to underfunding, which can quickly spiral into cash flow problems and an inability to sustain operations. Key areas often underestimated include initial inventory, the cost of goods needed to start the business, equipment and technology, computers, software, machinery, and other essential tools, permits and licenses, necessary legal documentation and fees, marketing and advertising, initial marketing campaigns to build brand awareness, insurance, coverage to protect against various business risks, professional services, legal, accounting, and consulting fees. Financial hardship can be avoided by making a thorough inventory of all possible startup costs and then setting aside a reserve of 10% to 20% for unexpected expenses. Raising more money than initially estimated is likewise advantageous to pay for these unanticipated expenses. Number 3. Poor cash flow management. Cash flow is the lifeblood of any business. Even if a business is profitable on paper, poor cash flow management can lead to its downfall. Entrepreneurs must understand the timing of cash inflows and outflows to ensure they can meet their financial obligations. Common cash flow mistakes include overestimating sales. Being overly optimistic about sales projections can lead to cash shortages when actual sales don't meet expectations. Delayed invoicing. Waiting too long to invoice clients can delay payments and disrupt cash flow. Ignoring expenses. Not tracking expenses meticulously can result in overspending and financial shortfalls. Lack of cash reserves. Not maintaining a cash reserve for emergencies can leave a business vulnerable during downturns or unexpected events. To manage cash flow effectively, entrepreneurs should implement a detailed cash flow forecast, regularly update it, and closely monitor actual performance against projections. Tools and software can aid in automating this process, providing real-time insights into the business's financial health. Number 4. Inadequate pricing strategies. Pricing is one of the most critical aspects of a business strategy. Set prices too high, and you risk alienating potential customers. Set them too low, and you might not cover your cost or generate a profit. Many entrepreneurs make the mistake of basing their pricing on competitors rather than their own cost structures and value propositions. Elements of an effective pricing strategy. Cost-based pricing, ensuring that all costs, fixed and variable, are covered and a reasonable profit margin is included. Value-based pricing, setting prices based on the perceived value to the customer rather than just the cost. Market-based pricing, considering what customers are willing to pay in the context of competitors' prices. Dynamic pricing, adjusting prices based on market demand, seasonality, and other factors. Entrepreneurs should conduct thorough market research, understand their unique value proposition, and regularly review their pricing strategy to ensure it aligns with their business goals and market conditions. Number 5. Overreliance on debt. While debt can be a useful tool for financing growth and managing cash flow, overreliance on debt can quickly become a burden. High levels of debt increase financial risk, particularly if the business faces a downturn or unexpected expenses. Dangers of overreliance on debt. High interest payments, reducing available cash for other business activities. Increased financial risk, more debt means higher fixed costs and greater vulnerability to economic fluctuations. Impact on credit rating. Excessive borrowing can negatively impact the business's credit rating, making future borrowing more difficult and expensive. Restrictive covenants. Loans often come with covenants that restrict how the business can operate, potentially stifling growth and flexibility. Entrepreneurs should carefully evaluate their financing options, considering not only debt but also equity financing, grants, and other funding sources. Maintaining a balanced capital structure and avoiding excessive debt can help ensure long-term financial stability. In conclusion, entrepreneurship is a journey filled with both challenges and rewards. By avoiding these 5 common financial mistakes, neglecting a detailed business plan, underestimating startup costs, poor cash flow management, inadequate pricing strategies, and over-reliance on debt, entrepreneurs can significantly increase their chances of building a successful and sustainable business. Each of these areas requires careful planning, continuous monitoring, and a willingness to adapt and learn. By prioritizing financial health and making informed decisions, entrepreneurs can navigate the complexities of running a business and achieve their vision of success. If you found these tips on avoiding financial mistakes helpful, don't forget to hit that like button and subscribe to our channel for more invaluable business insights. Share this video with fellow entrepreneurs who could benefit from these tips. Have questions or need more advice? Drop a comment below, we'd love to hear from you. Let's build a successful future together.